Today, we want to talk about insurable interest. Now, this is a very, very important concept when it comes to life insurance, in that an individual must have insurable interest in the person that they're going to insure. So this usually applies, obviously, to what we refer to as third-party insurance policies. And you'll recall in a different webcast, basically, that we talked about different kinds of ownerships and everything else, okay? So basically what we're saying here, insurable interest, it must have insurable interest. And the definition of insurable interest basically is there a potential for loss, okay? And that loss is what we call a pecuniary loss. In other words, this is not a personal loss, although obviously that's serious enough, okay? But basically what we're saying is if this person passed away, am I going to be hurt financially, basically? And that's why we refer to it as a pecuniary loss, pecunia, of course, being money. So that is essential in order for us to have an insurable interest. So the insurance company will look at that aspect of it very, very carefully, make sure that is there a reason why you're insuring this individual. So let's take a look at the different kinds of insurable interests that are available. So insurable interest obviously lies with yourself. So for example, I have insurable interest in myself. So I can buy an insurance policy on my life, basically because should I die, then my family will suffer, or whoever, that sort of thing there. So there is an insurable interest on myself. Now always remember that a lot of it also depends on what we call financial underwriting. So for example, if I was only earning $30,000 a year and I'm insuring myself for $5 million, the insurance company would question that and say, well, why would you want to insure yourself for such a big, big number, given the fact that you're only earning $30,000 a year? So they would have an issue with what we call financial underwriting. But forgetting that for a moment, assuming that everything is fine in that particular area, the question really is, do I have insurable interest in myself? And the answer is yes, I do have insurance in myself, because should I die, somebody will suffer a pecuniary loss, and so my family, and so on. I have insurable interest again in my child and my grandchild. So in other words, I can buy a life insurance policy on my child, again within limits, financial underwriting, all that kind of stuff there. Okay, so let's say that my grandparents want to buy a policy on my grandson, let's say for $100,000. It's perfectly fine. Okay, they may have all sorts of reasons for it. It's a situation basically that should they pass away, or you may want to make sure that they have adequate insurance for the rest of their lives and so on. So I do have insurable interest within limits, obviously, with my child or my grandchild. I have insurable interest in my spouse. Okay, so that's an important one. Okay, insurance in my spouse. So some of you may say to yourself, well, what if the spouse is a stay-at-home mom or stay-at-home dad, so they don't actually produce any money? In other words, there's no actual cash coming in the door. Where's the insurable interest there? Well, the reality is that should that person die, you're going to have to go and buy all the services that spouse is providing for you. So if you're taking care of your children, for example, you now have to go and actually find some place to park your children for the day while you're going to work. Somebody has to clean your house. Somebody has to do the laundry. Somebody has to all of these services that you are expecting from your spouse right now. All of those things now are going to have to be replaced, and that's going to cost money. That's going to cost money. So even if a person is not actually producing any cash directly, you might say, but the mere services that they're providing for you, those are insurable services. And therefore, should that person die is providing all those, you're going to have to go out and buy all those services. So it can be very, very expensive, particularly raising a family. 2 or 3, 4 kids, whatever it is, can be a very, very expensive proposition. So do I have insurable interest in my spouse? Absolutely. I have that insurable interest, okay? I have insurable interest on dependent for support. In other words, if in fact, for example, I have a brother or a sibling or somebody that really depends on me, let's say, to making sure that their lifestyle is maintained. So a disabled individual, mentally, physically disabled, whatever, they are dependent. So if I'm dependent, let's say, on somebody for my well-being, even though I may be an adult, but I am disabled, I'm mentally ill or whatever, and that individual now is really helping me financially to maintain me and so on. Obviously, if that individual should die, where am I going to get the money to continue on in a reasonable lifestyle and everything else? So if you have anybody that's dependent on you, then they have an insurable interest on you. Because should you die, that money will dry up. And then what's going to happen? So once again, you go back to that pecuniary loss. So there is an insurable interest in terms of a dependent support. I have an insurable interest in my employee. If you remember in a previous conversations that we've had, indicated key person insurance, for example. Okay, should that key person, who's the best widget maker, the best employee I've had, or whatever the case may be, should that person die, it would cost me a tremendous amount of money because I have to hire somebody, I have to train somebody. All of that is, of course, dead time. The bank themselves may get nervous because this individual was really very much responsible for much of the sales, for example, that the company produced. Now that person is dead. And so the banks get nervous. They may call the loan, line of credit or whatever it is. So I have an insurable interest in my employees. And the last one, of course, I have an insurable interest in my partner. Okay, so if you and I were partners, I have an insurable interest in you, as you have an insurable interest in me. So what happens, I insure you, and I become the beneficiary. You insure me, and become the beneficiary, okay? If it was a corporation, for example, then of course we're employees because it's a corporation, separate entity, so the corporation has an insurable interest in us as employees, and the corporation will be by the policy, the corporation will be the beneficiary, and so on and so forth. So all in all, basically, it says that wherever there is a potential for loss, okay, then, and that loss, of course, being a pecuniary loss, there is, in fact, an insurable interest. That insurable interest, okay, must exist at the time of application. So in other words, when you apply for the coverage, that insurable interest has to exist at that point. If it doesn't exist, then the insurance company will simply say, forget it. There's no reason for you to insure this person because you're not going to lose anything. So let me give you an example. Let's say that I automatically now send a policy down on your life for $100,000, let's say. And the obvious question is, the insurance company say, well, what is the loss here, Sam? What's the purpose of all this? And you don't really have an insurable interest. There's no real reason for me to insure you. So the company will say, well, look, there's no potential for loss here, so therefore the policy, we're not going to be able to issue this contract. However, let's say that I lend you $100,000, and obviously you're going to pay me back, but what if you die along the way? And now I no longer I'm able to get that money. So how do I insure myself against the potential loss that you may die before the $100,000 is paid for? Well, now I have insurable interest, you see. And so therefore, because there is that potential for loss. And so therefore, it all depends really, is there a loss? If there is a loss, then I can insure you, okay, basically. Always remember that insurance companies are in the business of insuring what we call absolute losses. In other words, is there going to be a loss? And if there is, then it is insurable. So on that point, the reason why we have this whole question of insurable interest is this here. Avoid speculation. In other words, gambling. This is a situation where you just can't buy any life insurance policy on anybody just like that, even though they may consent to it, because if there is no particular loss, then the insurance companies say, well, you're gambling. There's no real reason for you to buy this person because buy insurance on this person, because if this person dies, there's no actual potential loss here at all. Okay, so therefore you're really gambling. So to avoid speculation, as they call it, basically to avoid speculating on somebody else's life, there has to be insurable interest. But once again, that insurable interest has to exist at the time of underwriting the application. Once the application is done, everything is finished and so on and so forth, okay? Let's say, again, going back to our example, I lent you $100,000. Now you paid back the $100,000. So therefore, you might say, okay, there's no more insurable interest at that point. So therefore, the policy should be canceled. Not so. Not so. The insurance policy is a unilateral contract. Because it's a unilateral contract, that basically means that the owner of the policyholder, the insured, okay, has all the rights. So if I decide that I'm going to continue on paying the premium on that particular policy, even though you've paid back all that money and everything, the insurance company cannot cancel that contract. So I may turn around and say, well, I understand that you have a health issue, whatever it is, and it may be a good idea for me to just keep on going with this policy, even though you paid me all the money back, right? But because it's a unilateral contract, and as long as the premiums are being paid, the insurance company cannot cancel this contract. I can simply keep on going with this policy forever and a day, and when you pass away, I get my $100,000 basically. And that goes for any of these, by the way. It goes for any of these. So the situation basically is that there's an insurable interest at the beginning of the contract, but that stays with you all the way through. So even after, for example, a spouse, let's say that you divorce your spouse or something, that doesn't mean that the policy is now canceled. That basically all that means is continue on paying your premium. And you will continue on having the insurance policy on your spouse. And when your spouse passes away, you get the you get the cash. Why? Because it is a unilateral contract. So under a unilateral contract, all the rights and privileges remain with the insured. In other words, all the fiduciary responsibilities that you're familiar with and all that all lie with the insured, not the life insured. The life insured is a separate entity altogether. So all the responsibility really lies with the insured. And so because the insured decides that they'd like to keep the policy for whatever reason, continue on paying the premium, therefore the policy will simply continue on. And when that person does pass away at any time in the future, or whatever it is, you will be the beneficiary of that policy. Okay, so we'll leave it there for now, and we'll see you soon.